Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Percent and a half higher on the Taiwanese index.
We are doing well with China.
Immediate resistance after that is 24,310.
They've gone ahead and announced a capex in the Middle East.
What do we have? 25,161.
It will be around 2,000 crores of book. I'll keep it that.
If you look at the age of inventory, I think they're all fairly healthy.
Stopping of permanent magnets from China to India, which will affect our auto sector particularly, and several white goods and other sectors.
Total inflow via the NFO route go back above the 4,000 crore rupee mark.
It's a subdued session, although in the green for the Nifty.
That was the day so far. Things have been very quiet on Dalal Street this Tuesday afternoon. You're watching Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Surbhi and Nigel. Guys, just looks like we've taken a breather. Pause.
It's sort of complete dead heat.
Yeah.
It's almost as if nothing's moved on the index
in just about a 0.5% trading band. At the low also, we're at what? 25,055.
I guess the mood is a bit cautious. It's a little cautious across global markets as well. I mean, until we have further headway on this whole US-China trade deal. So that's the global watch point. And the local watch point, what you heard in our news wrap as well. I mean, those inflow numbers on the mutual fund side, the SIPs are still strong. But hey, guys, let's face it. This is not a market where mutual funds are being pumped with 40,000 crores, every month, which they have to invest. The flows have trickled to, they've halved. I mean, from 41,000 to about 19,000. And there's so much additional paper supply, right? All the blocks, all the OFS. Yeah. So it's all, taking up the liquidity. And I guess it's okay. Maybe it's sort of measured steps. That's what we're taking today.
Well, that's right. I think even the broader markets are taking a bit of a pause today, right? Because we're getting so used to those markets outperform. But if you look at the crisscross lines, so they're getting closer to each other on a Tuesday itself. So we had way more number of stocks that are advancing in the morning. It was around 1,800 to around 1,900. Now those lines are almost pretty much even Stevens as we speak. Very, very close to each other. But you pick the right stock, obviously you're making good amount of money. Case in point being a few stocks like, Jindal Saw that we pointed out earlier today. That stock, in fact, is up and about in trade. Grasim has done very, very well. So individual stocks doing a thing of their own, guys.
Absolutely. I mean, that's the way it's played out. Just very quickly, let's see in terms of individual stock trends, what can we spot for you? The one clear trend is that financials have underperformed today. Friday was a great day. Monday was a great day. Today, they've taken a bit of a breather. So on the Nifty, that means some of the bigger banks like ICICI Bank, HDFC Bank, SBI, the lenders are on the back foot. But even others like, something like a Geofinance, etc., they're on the downside. Even in the broader market, if you see RBL Bank, Bandhan Bank, Bank of India, a lot of these names have cooled off. Railway stocks, which were partying very hard for most of last week, they're also seeing some profit taking now. So your RailTel, RVNL, a lot of these stocks are on the back foot for now. But of course, we have some movers and shakers here and there. But in general, these are the pockets where some of the excitement seems to be ebbing.
And as a sector leader, I think IT stands out. The Nifty IT index is up more than 1.5%. TCS, Infosys, HCL Tech, Wipro, all have gains in excess of about 1%. And then you've got a 2.5% pop coming in on names like LTI Mindtree, Tech Mahindra, Persistent. Coforge, of course, has been a big mover as JP Morgan reiterates their bullishness on that mid-cap IT name. We'll talk more about all these themes. For now, things are on the quieter side. Let's get in a few closing strategies as we prepare and position ourselves for the last hour of trade. Mitesh is now with us for that. Mitesh, what trades have you taken and what would you recommend?
Actually, very surprisingly, a very, very quiet day. In fact, after the breakout yesterday, I was hoping for some strong continuation. That's not happened, but the structure hasn't weakened as yet. So in that sense, I think, maybe, we'll hold out long positions. What has happened is that the Nifty IT, as a pack is doing slightly better. And that's why, trading opportunities can be looked at. Look at an HCL Tech as a buy with a stop below 1650 for targets of around 1700 or 1700 plus. And with the disclaimer that I have some positions in TCS, that's a buy as well with a stop at about 3430 for targets of 3525.
Okay, so two large cap IT names on Mitesh's list. But let's talk about Grasim. That's the big mover today.
Well, that's right. Grasim is the big mover in trade today because of Morgan Stanley note. They've gone ahead and they have upgraded the stock to overweight. They've raised its target price around 3,500 from a little sub of around 3,000 rupees earlier. Now, they point out that Grasim has multiple opportunities playing out that could lift the share price just in the medium term. So 4 big points is what they've highlighted. Point number 1, the paints business had fared better than expected since the launch. And so they raised the paints business valuation across various scenarios. Now they estimate 360 rupees per share in their SOTP. Earlier, they had given only around 150 rupees of value to Grasim stock price for the paints division. Now, they also say that, in fact, Ultratech remains the largest value driver for Grasim, and the company will benefit from a multi-year earnings compounding story at Ultratech. So that's point number 2. Point number 3, on new age businesses, they say they're scaling up fast. It's driving earnings and value optionality as well. And point number 4 is the holdco discounts continue to moderate, and that's why they believe that Grasim is one of the top picks. Explains why the stock is excited in today's trading session. Well, let's go across to Mehruboon Irani, who joins us on the show. Hi, Mehruboon. Grasim seems to have made, a dent in a lot of these paint companies because, many of them have not given any returns in the last 2 years. Any view on the paint space, and if particularly on Grasim?
I've been perpetually negative on the paint business. So I've always stated that it's great to have a sibling of yours or your prodigy or your son or your daughter working in an Asian paints, but is it a company where you're going to make money? Compare the valuations of paint companies in India versus paint companies abroad, and you would understand what I'm saying. It's ultimately a commodity business. Your branding it is different. Now, coming to your question as far as Grasim goes, I think it's going to be a dent or a little bit of damage also as far as market share goes for the other companies once Grasim enters paints business in a big way. Grasim as a stock, I also read the Morgan Stanley report. Yes, there is a holding discount. Yes, Ultratech is a great business to be in. In fact, I would prefer to buy the Ultratech cement stock right now, because this is an industry which I like, which I understand, and where I feel that Ultratech, being a leader with a great geographical presence, should continue to do well. Coming to value unlocking and all, yes, if you add the sum of the parts, there is definitely an upside in Grasim. But as a direct business, instead of looking at any paint company, I would look at the cement business, and Ultratech definitely would be one of my top 3 picks, along with ACC and Abuja Cement.
Okay, got that point. Mehruboon, great to have you on. I want to discuss the financials with you and maybe get your take on the asset managers as well. I'll come to that in just a second. Let's look at the Amphi data, the industry data that came out, and it continues to be a sobering reality. That's how I'm looking at it, because for the last 4 months, month after February, we've seen the net inflows into equity funds dwindle, and those bars really tell you the story. January, we were at 39,000 crores. November, December, we were over 40,000 crores. Now we're at, just under 19,000 crores. So this is something that you can't deny. The SIP number is very good, and I'll come to that in just a bit. But that's on the equity side. Now, this slowdown has been showing up pretty much across the board in small, mid, and large cap. But large caps, it's very pronounced. Large cap funds have pulled in only about 1,250 crores. That's the bar coming up. That's in the month of May. Even in the small cap and the mid cap category, the flows month on month have dipped between 15% to 20%, depending on which one you're looking at. Small caps actually are still doing okay. 2,800 crores in mid cap. Small cap funds still getting a lot of attention from investors. They've pulled in about 3,200 crores. So then why is this big number falling so dramatically? A large part of that answer is NFOs. When we were getting 40,000 crores month after month, it was NFOs, new fund offerings, that were pulling in lots and lots of money. The NFO numbers have been dwindling in the last couple of months, and that's a very good graphic which tells the story. It's better than April. I mean, April we completely sort of hit a bottom, 7 NFOs. Compared to that, 19 NFOs in May. A lot of these NFOs are coming in from the passive category. A lot of the index funds, ETFs. That's where the product innovation is happening. So at least that number's gone back above 4,000 crores. But generally speaking, NFOs have not been pulling in as much money as they were earlier. Moving on to the silver lining then, that remains the SIP number. And that's rock steady. Look at those bars. I mean, those pillars are just rock steady. 26,000, almost 26,700 crores now. So that's the good picture. The overall AUM for the mutual fund industry, that has crossed 72 lakh crores now. So as an industry, the industry keeps growing. By the way, a lot of money has gone into hybrid funds this time. Flows into hybrid funds are still very, very steady. Gold, gold funds are still picking up the money. Balanced advantage is a category. So investors seem to be now using the hybrid route. Some of those funds are also very tax efficient to park their money in an uncertain and volatile market. So that's the sum and substance of it. Merabu, now let me ask you, while the capital market plays have done very well in the last couple of months, whether it's broker stocks, stocks like Angel Wealth, etc., on, asset managers, whether it's Aditya Birla Sun Life Mutual Fund or HDFC AMC, what's your thought here? Do you like these businesses at all, or would you play the whole wealth story through other parts of capital markets?
No, if you like the market, if you're positive on the market, of course you should be one or two, at least one or two stocks in this particular space of people who ultimately are doing business for you. That is the mutual fund companies, AMC companies, maybe an angel broking, maybe a Motilal Oswal. So you have to be in one or two of them. And the question which you are asking, and you also said it before that most of the stocks have gone up a little bit too sharply. So you have to understand one thing, that capital markets are here forever. The point is, you are in a market called India, which is ultimately going to relatively perform better than the rest of the world. The businesses are going to keep on growing. Inflows are keeping on increasing. Now, whether there's a slight drop here and there, honestly, it doesn't matter. The point is, this is a business which is going to be there forever, and therefore any pullback, according to me, should be used by people who still don't have too much of exposure in this type of stocks to go and buy into them. Yes, there's always a fear in your mind that these stocks have really gone up by 40, 50, 60, 80% over the last few months. Should I go and buy into them? So a pullback here and there should not unnerve investors. They should understand this is a business which is there for real, and which will keep on growing, and ultimately the well-managed companies in this particular space will also do well. Even I am honestly not able to define to have holding those stocks. I don't understand as to why an MCX should be presently priced at this, and a Bombay Stock Exchange should be priced at this, and why the NSE premium has gone up so sharply. It's difficult. It's difficult to give a call. The answer is very simple. There is too much of money going into this particular space. So action in the market overall is getting skewed towards certain sectors, and capital market intermediaries is one of them.
Money generally follows returns, and returns have been muted for the equity markets with all that kind of volatility that we've seen. Quick word on Jana Small Finance Bank. They've made an application to the RBI for a universal banking license. Generally, how does this play out? Have you looked at it or do you have any thoughts on this?
No, honestly, no. Honestly, no.
All right. Let's talk about the telecom sector, because CLSA has come out with a note where they basically analyzed the year gone by for the industry. And they're saying that the sector revenue growth was pretty good. 13% up is the India mobile revenue growth last year. And in this, it's Bharti Airtel right on top with an 18% growth. Jio did well, 14%. Vodafone Idea paled. The growth was just about 1%. Remember, the key driver for the sector revenue growth were the tariff increase. Now, when it comes to the market share, Reliance Jio is the most at 41.8%, Bharti Airtel at 38.7%. Vodafone Idea continues to lose market share. Last year, they lost about 1.6 percentage points in terms of market share, and it stands at 14.1%, their market share, and that is down 27% from its peak in FY27. And they're also talking about Reliance Jio and Bharti's growing dominance in the market, and it's truly turning out to be a duopoly. Bharti and Jio together account for 81% of the sector telecom revenues. And according to CLSA, that number is only going to grow and perhaps even hit 85% by FY27. So that's the state of play when it comes to the telecom sector. And CLSA has analyzed the TRAI data for the year gone by, FY25. Meraboon, Vodafone Idea is sort of a dead stock. Bharti Airtel doing very well. But it's also run up so much, 160, 170% in the last 3 years. Industar's hands are tied to Vodafone Idea in a way. So how does one play telecom?
I think telecom at most from the present levels can be a compounder, especially the top two players which you mentioned. We need to understand that this business depends a lot on tariff hikes. We need to understand that there could be a major foreign player also coming into this segment maybe over the next 1.5 years. So maybe the economies here and there will change. So is this a sector, or are there the stocks which I will go and buy in a hurry? My answer would be clearly no, because I am a strong believer, and I've been trying to express this over the last 3-4 months, that the year 2025, in terms of the frontline indices, could be a year of consolidation at most. A rally, if anything, would be 5, 7, 8%. You don't buy money in good stocks, you buy money in the right stocks. So if you're going and saying that I want to be in blue chips only, I don't think money is going to be made, because if you believe that blue chips are Hindustan Lever and Colgate and Nestle and Reliance and Infosys and TCS and those type of stocks, I don't think investors have made money in these stocks, at least for the last 18 to 24 months. But if you're in the right stocks, say you were buying into oil marketing companies and they're giving you a quick 20-25% return because oil came down, or you were in Bothut and Manapuram, where gold was going to go up for reasons well known, because this world is becoming a dirty place and precious metals are going to do well, so you would have made more money. So I would say that this is the time where stock selection will be more important than anything else. So buying into a frontline sector like telecom, just because I want to be there, like you want to buy an insurance company, please do that. They are great businesses for compounding, but to buy at the present level expecting a return over the next 1 to 3 quarters from here, I don't think you're going to outperform.
Okay, all right. Maribon, I wanted your view on Jindal Saur or any other pipes makers that you're bullish on. I'll tell you why. Because, we had Welspun Corp that came out with a very good set of numbers, and now things are looking up. Remember, these are going to be pipes that will be used in the transmission of oil and gas. And there appears there's a big runway with regard to Trump going for drill, baby, drill. So Welspun Corp is the stock. Now, Jindal saw a surprise on the positive side. Welspun Corp is making a fresh 52-week high today, but Jindal Saw is a far cry away from its 52-week high. Getting into this announcement, the street was very, very disappointed, with regard to the visibility going ahead. However, late last evening, they went ahead and on the exchanges, they have announced that they're going to be putting $100 million of investment in the Middle East region. Now, the Middle East for them includes Saudi Arabia as well as the UAE. And they're talking about, having 3 different parts of this business. One is where they'll have a 100% stake. The other 2, they'll have 51% stake apiece. And the total investment, equity investment, is $100 million. So there'll be a debt component as well. But why is this a street like this? Because they were fearing first no growth. Second factor is the stock has got absolutely hammered. Even after today's big move, it's still 25% down in the last 1 month or so. And point number 3 is the stock, even after this sort of a move, on an FY27 EBITDA, it trades at less than 5 times EV upon EBITDA. So put these 3 factors together, that stock is moving higher on large volumes. Maribon, any view on Jindal Saw or any of these stocks with regard to pipes, transportation of oil and gas?
I think you mentioned both these names, so let me give a clear disclosure. I'm personally holding Welspun Corp. But having stated that, results were impressive, con call was good, projects are good, what Trump is doing, what the Middle East is going to offer Welspun Corp, everything said and done. The point is, I'm holding it, but yet, despite that, I'm stating honestly, at the present level, I think Welspun Corp to go and put incremental money. The point is, the stock right now is very well discovered. Somewhere I feel it's over-owned in the pipe sector. Whereas if you look at Jindal Saw, which as of now I don't own, I think the stock is going at valuations where you're not going to lose money. And if the company decides and goes in for those 2 joint ventures and other things, I think this stock is going to definitely outperform in terms of stock price performance over others in the particular space. So despite owning Welspun Corp, and I'm going to continue keep holding on to it, the stock of Welspun Corp is not very cheap, because ultimately it's a pipe business. Let's not forget it. Pipe business, you don't get a valuation of 20-25 times, though it is not quoting at that level. But between Jindal Saw and Welspun Corp, despite holding the latter at the present price, I think Jindal Saw possibly has the potential to give better returns if all goes well for the company over the next 3 or 4 quarters.
Okay, that's Jindal Saw. Got that. Maribon, before we let you go, I have to ask you about the whole financial story now. Now that we know that the RBI is in a very good mood and we've got this big liquidity and rate cut bonanza. The question is what to do, what kind of stocks to play from here on. I mean, till yesterday, even the tier 2, tier 3 financials were running well. But again, today the mood is profit-taking. So apart from tried and tested names from the likes of an ICICI Bank, maybe HDFC Bank, would you look at anything else beyond the Nifty 50 when it comes to financials? What are your topics?
There are quite a few stocks, as I mentioned earlier to some other question. I had mentioned that this is going to be a market in which you have to be very stock specific, selective, and not get too carried away in the momentum, because I personally believe there are some pockets of the market which will sooner or later become very expensive in terms of valuations. Coming back to the general market, if you allow me to comment two things on it, I think India definitely stands out on a relative basis to the rest of the world. The main point is oil has come down. The main point is dollar index has come down. The main point is that RBI has opened its wallet and distributed as far as liquidity goes. And this money ultimately is going to find its way in either equity or possibly even a real estate, not ruled out. The big worry for the market continues to be geopolitical and what happens as far as July 9th goes and what that man does, because there are various pronouncements he keeps on happening here and there. So if nothing much happens for the rest of this month, I think somewhere the market will start getting nervy as to what is going to happen as July 9th comes. On the other hand, you have a market like India, where the world, despite not being a good place, you very well know that the upside for the market could be capped. So you have to go and buy into select stocks. Now, in this particular space, there are a whole lot of sectors I still continue liking. I still like tourism, I like hotels, I like NBFCs, I like banks here and there. I think a pullback should give an opportunity. I like capital intermediate stories, and I like the capital goods space. And there are quite a few interesting names over there. The worry is that people end up chasing momentum and buying at very, very expensive prices. Like I think last week I was here and Welspun Corporate announced its results. From there, the stock has already gone up nearly 15-17%. So it's a great company even now. It may give you returns here and there, but that is the only fear which I have, that people should understand the valuations and learn to possibly be a little bit fleet-footed and possibly move from one stock to another. This is not a market, as I mentioned earlier also, that you buy today, wait for the next 2 years. Capital market is a great place to be. In India, the good surely paisa milega hi milega. It is not like that. You will have to continue monitoring your portfolio and not getting carried away into too much of promises which some managements give and buy at lofty valuations.
Thank you very much, Mehriboon, for joining in this afternoon. Need to get into a break. As we do that, CNBC TV18 Access is a premium membership-based service available on CNBC-TV18.com. It offers members exclusive content, market intelligence, and expert thought leadership. The membership also includes access to CNBC TV18's flagship events, interactions with a journalist, along with that, curated studio tours, e-learning sessions, masterclasses, and curated lifestyle benefits. Designed for an immersive and enriching experience, it empowers members with premium business intelligence and unique lifestyle benefits. The power of insight, the privilege of access, exclusivity, experiences, and influence. Yours to claim. Become a member. Log on to cnbctv18.com/access/plans.
Well, let's continue tracking the market and welcome in our next guest. Sunil Kaul, Global Emerging Market Equity Strategist at Goldman Sachs, is with us. Sunil, what a pleasure to welcome you back on the show. Great to have you on. And the market is now wondering which way to go because we're almost getting back to all-time highs. It's trying to take out the recent trading range as well. But then I guess, some nervousness creeping back in. Let's sort of understand your construct. How do you feel now that the earnings season is wrapped up? A little better than most estimates. But what's the overall thesis?
Yeah, Surabhi, first, thanks for having me on. I think you're right. The earnings season was much better than expected, even better than what we as well as consensus were thinking. But I think in terms of the markets where we are, there are a couple of things which are important in here. One, I would say, I think the rally we have seen in the markets is obviously a sort of global rally, which happened because people got a bit more comfortable on the tariff side. And Nifty has rallied 12% from the lows. But I think what's important to keep in mind that if you look at the broader emerging markets, that rallied sort of almost 20% from the lows. So it's kind of a more global rally. And that's partly because market is starting to kind of take out any sort of left tail risk from the global growth slowdown because of the tariffs, right? I think specifically for India, what matters more in our view is that what happens on the domestic growth cycle, right? So if you remember, we had been sort of in this growth slowdown, earnings downgrade cycle for the last 8-9 months. And that was the prime reason why we had downgraded the market back in October last year. And I think there, mark to market, we are starting to turn a bit more sort of constructive fundamentally, because our core view is that given how the season has been panning out, it does look like the earnings season is kind of bottoming out here, and we're kind of seeing signs of recovery in corporate earnings. If history is any guide, we have been in this downgrade cycle for 8-9 months now. I think the typical downgrade cycle tends to be like 10 months long, going back to the last 2 decades. But I think more importantly, I think the estimates are become more reasonable now, right? Coming into the year, we had consensus looking at around 16% earnings growth in India. We were more like 12-13%. We obviously cut our numbers a little bit after tariff announcements. But right now, if you look at the consensus numbers, they've gone from 16 to 11, which is more or less in line with where we are. So our sense is, look, I think the numbers have kind of caught down or to our estimates. Cycle has been sort of long enough over the last 8-9 months. And I think there are enough signs given sort of the RBI's sort of easing, given the fact that as you head into the sort of festive season, hopefully we get a decent monsoon, you could see a recovery in consumption. And so we are kind of hopeful that the earnings cycle is kind of turning around here. I think the issue obviously remains that the valuations have kind of re-rated back to 23 times, which is expensive. And so we don't have as much upside at the index level for Nifty. So we have a 26,200 for Nifty, which is, I guess, 4-5% upside from current levels. And if you bake in currency appreciation of 2-3%, that's roughly around 6-7% upside in dollar terms, which is not bad given where the markets are. But we think it's kind of more a stock pickers market, more sort of alpha beneath the headline index. And that's where we are advising people to pick up stocks and sectors.
All right. Hi, Sunil. Good afternoon and good to see you. With Nigel on this side. Sunil, good to hear that you're sounding a little bit more optimistic with regard to earnings going ahead. And that's why you're factoring in 12% odd and the Nifty target, as you said, 26,200. But the macro backdrop is looking much better for India. Crude oil prices are well behaved. The rupee is fairly stable. And also the policy coming out of the RBI is looking solid. And the optimism is there on the consumption picking up here in India. So in that sort of a backdrop, could you comment first on the macros? And also with this backdrop, I believe you'll have upgraded financials as well as consumption. What do you like from the consumption themes?
Look, I think the macro is obviously better, Nigel, as you mentioned. I think that's kind of better for everyone. Most of the emerging markets are kind of net importers of sort of oil, barring a few pockets, kind of are inherently short dollars. And so I think the global environment where you have lower oil prices, weaker dollar actually tends to benefit a lot of the markets. India is not the only market, to be fair, which benefits from that. But I think if you compound on top of that, the domestic situation, wherein, as I said, we do think growth is kind of picking up a little bit here. We do think, obviously, fiscal drag is less than it has been in previous years. So that is not a positive, but at least the second derivative is kind of turning favorable there, as meaning that the government doesn't need to consolidate as much as it has done in the prior years. Monetary policy obviously has turned much more favorable. especially in terms of the liquidity. And then there is the expectation of consumption recovery, as you put it. So if you combine both the external environment becoming a little bit better, but equally kind of domestic environment also turning a bit more favorable, that's the reason to be a bit constructive, which is what I said at the beginning, that the reason of not having a stronger upside is just the valuations, not the cycle. I think, as I made pretty clear, I think we are pretty constructive on the cycle recovering in here. To your other question, yeah, we did upgrade financials a couple of weeks back, and we are sort of advising people to be sort of positioned within financials and consumption. I think consumption, we have the variety of sectors where we are overweight on. So we are overweight on autos, we are overweight on both discretionary bit as well as staples, as well as kind of we like to play consumption through the broader theme of tourism, which obviously includes kind of hotels, restaurants, airlines, bits of that. And so it's a broader range of consumption sectors where we are overweight on. On financials, I would say, look, I think the key view there is that you probably have a better earnings visibility now because the RBI obviously front-loaded rate cuts, which may be sort of impacting NIMs in the near term. But I think as we sort of some of that NIM pressure could be offset by the easier liquidity conditions and the CRR cuts from September onwards. So we think some of that pressure could be offset. But equally speaking, I think you could see better sort of credit offtake with the better liquidity conditions. And net, we think financials should still do okay because it's one sector where valuations are still more mid-cycle as opposed to expensive. And if your earnings visibility and ROAs are improving, that should be better for financials. The one thing I would say, I think you still need to be a bit more stock specific within financials. And so we do like pockets of banks and BFCs, small size banks. I think with banks, you probably are looking at banks where you have high loan to deposit ratios. Our analysts have been flagging that within NBFC, we like a few pockets, especially guys who have sort of a higher proportion of fixed assets, for example. And I think those are the pockets you need to sort of look at. So be a bit more selective, but broadly speaking, we think financials and consumption should be sort of driving the markets higher in this leg of the rally.
Sunil, hi, afternoon. This is Rima here. So, so far the DIIs were cushioning the Indian equity market. So despite FIs selling or muted earnings growth, India continued to do well. But now the latest equity inflow numbers show for the month of May, there is a sharp moderation. Is that a bit of a risk, especially when you see it in light of the expected supply that's coming into the market?
I mean, yeah, part of it could be that. I mean, we are obviously sort of busy on our desks in terms of block deals and activity. And so there is a bit of supply that's hitting the market, to your point. But I would say, I think we also have to keep in mind what the global environment is looking like, in the sense, I think there is a increasingly more and more focus from clients we speak to in terms of diversifying away from sort of US to non-US equities and EM. And I think we're kind of seeing inflows into many pockets of EM. I think from the April 9 lows, from the data we are tracking, there is close to sort of 20 billion of inflows that have come into the emerging markets. 6 or 7 billion of that has come into India. So India has obviously got its share. But I think this broader kind of need for diversification and sort of reallocation of flows out from US to non-US pockets is something that could be a tailwind from a FII flows perspective for India as well. And as we all know, I mean, large part of the rally and the fact that market was held up, as you said, is because of the domestic flows and SIP flows, and foreign positioning in India is still pretty light. And so, I mean, just looking at the year-to-date flows, you're kind of at one point back in April, you were down 18 billion year-to-date. Now with the inflows, you're kind of still down 11 billion year-to-date, right? So net, we haven't seen any inflows in the market, right? So I would say the foreign positioning is still clean. At the margin, you still, I mean, from what we track, the domestic investors are still running a little bit higher cash levels than they historically have, close to kind of 6% versus 4% historically. So we still think that domestic investors also have, or mutual funds still have some firepower left to support the market. So the combination of sort of domestic liquidity plus kind of broader money coming back into the emerging markets could mean that I think the liquidity environment could remain supportive and should be able to absorb any supply we are seeing in the markets.
Sunil, I mean, to go back to that point you made, you said the leaders of the market in this phase will be consumption and financials. So that would be a departure from where we were till September last year, right? It was all industrials, capital goods, railway, PSU, defense, all of that. So do you see those sectors falling off the wayside? Because we keep seeing these off and on trading rallies. I mean, railway stocks, for instance, last week were quite excited. What should people be doing? What's your advice on the old leaders, or the yesteryear's leaders on the industrial side?
It will be a rotation in the market, Surbhi, as said. I mean, the last 18, 24 months was obviously unusual in the sense that, as you said, financials were not the leaders of the market, and it was kind of more industrial-led rally. Although I think if you go back in time, a large part of the bull markets in India, or sort of stronger performance in India, were actually led by financials. So in that sense, it's not sort of a large departure from where the history is. But obviously, there were reasons for financials not doing well, and large part of that was because of the regulatory sort of macroprudential tightness. And I think the clear evidence that RBI doing a U-turn on that policy is what is the catalyst, I think, for financials. And so I think we are fairly comfortable with the fact that financials could be the leaders, and with all the sort of catalysts that are lining up for the consumption, that seems to be the case. The reason we are not as bullish on the broader infrastructure side of things is obviously because private capex, as we all know, hasn't come back, and it does feel like at the margin there is limits to how much the government can continue to spend on infrastructure, given other needs as well. And so we are looking for rotation out from some of those pockets. The one thing I would highlight, though, I think we have in our allocations, we are underweight cement, we are underweight industrials. So we do have that strong preference of financial consumer versus the rest of the market. But we are sort of neutral on defense. So if there is one theme within that broader manufacturing industrials complex where we still feel that there is more to go, given how the geopolitics and the world is moving, that would be defense. So we wouldn't be sort of cautious on the defense names. I think there is more room for that to come through if that gets backed up by the government orders and all of that. But we will be probably more cautious on very highly capex sensitive sectors, which are more to do with sort of construction cycle, so to speak.
Okay, all right. That's pretty comprehensive. Sunil, thanks very much. Explains your point of view very well, and the rotation and leadership change that you're expecting in the market as well. Great conversation. Thank you so much. And we'll look forward to the next one. You have a great rest of the afternoon. Well, that's a view from Goldman Sachs coming in. We do have to take a quick break on that note. Come back on the other side. And of course, as usual, we'll get you some final trading ideas. They'll come up with Mitesh, and then, of course, some of the latest from dealing rooms as well. Welcome back. Still an absolutely directionless screen. That's what you've got. Look at the Nifty, look at the sensex, look at the mid-cap index. There's no direction. One of those really odd days. We've got Mitesh back with us. Mitesh, must have been difficult, right? I mean, beyond stocks, I don't know if on index anybody managed any kind of significant trades today. But what's your final advice?
I don't think there's much trading on the index, I think. But on the stock side, I think there's no reason to get negative and look at shorting. So we're still trading with the long bias, believing that this could be a one-day kind of a subdued day. But I'm of course similar to the BTSC. Keep it double at 155, look for a target of around 1,085 for tomorrow. And the other one, is Tech Mahindra. That's a BTST with a stop at 1600 for target of 1625.
Okay. One more IT name on Mitesh's list. I guess that's the only big, in the large cap space, those are the only big movers. But let's talk about,
by the way, just wanted to point out that newsflash. Yeah. Okay, you saw that all right.
Yeah. So basically, I think Diageo is saying that they're denying any plans of selling their stake in RCB, the IPL team, Royal Challengers Bangalore. This was one of the news pieces which had pushed the stock of United Spirits higher. We spoke to Abneesh as well, and he said that overall he's very constructive on United Spirits, but if this monetization takes place, then it would be even more positive. So he would have raised the target price on the back of that. But Diageo...
This was a Bloomberg story in the morning.
It was a Bloomberg story in the morning.
But I think this is as clear as it gets, that these reports don't have any merit right now. I think we've got Mangalam actually on this. Mangalam, take it away. So... Diageo wants a piece in the pie, RCB.
So there's a couple of things we need to keep an eye out on here. One, Diageo PLC. The news that came in on Bloomberg this morning was from Diageo PLC's end. Diageo PLC is the international parent of United Spirits, which owns Royal Challengers Bengaluru. So perhaps the story from Bloomberg would have been that they have appointed advisors to look at the valuation of Royal Challengers Bengaluru. And that story did carry the qualification that this is very early, where they may look at part stake sale, full stake sale, or this may not culminate into any sort of action or any sort of deal itself. So with that on board, while Diageo refused to comment on this story, we reached out to United Spirits this morning, and they said that this is speculative in nature and they wouldn't want to comment on that as well. But I believe that because of their, having to clarify this to the exchanges, that's exactly what they've said, that they are not pursuing any discussions with regards to any sale in RCB, and the news is speculative. But United Spirits wasn't the reported entity which was looking at any stake sale. Any case, it was Diageo PLC, which was the international parent. But be that as it may, it may well be a valuation exploration exercise by the parent, largely because the times are best right now for them. They've just won the IPL. The things are peaking or looking to look good for them. And we've seen a lot of these IPL teams very recently bid for higher amounts for the franchise as well. So from a time when they first bought the team at around $400 million US dollars way back in 2007, to look at it at $2 billion right now is a big jump in valuation. So they may just be doing that exercise. Having said that, what this does is that it makes you think, are there any other opportunities here as well? In the listed space, there are three. You have Sun TV, which owns Sunrisers Hyderabad. You have RCB, which is owned by United Spirits, 100% of their stake. And finally, you have RPSG Ventures, which owns 51% stake in Lucknow Super Giants. So if you look at the valuation exercise, United Spirits looking at $2 billion of valuation, that makes it 15% of their market cap. Sun TV, no two IPL teams are very different from each other when it comes to the valuation. So even if you give it a slight discount to RCB and make it at around $1.5 billion, then it's around 50% of Sun TV's current market cap. And RPSG Ventures, I haven't changed their valuation over and above what they actually bid for the team 2 years ago. So they are at around 145% of RPSG Ventures' current market cap. But remember, there is a fair amount of holding company discount that needs to be ascribed to the RPSG Ventures business as well. So for Sun TV and United Spirits is 15%, Sun TV is 50%. United Spirits currently not looking to sell as per the company and to the exchanges right now, but an interesting exercise to look at the valuation and the IPL team value.
Oh, absolutely, and those numbers are very, very interesting, especially RPSG Ventures and then, the percentage that comes in for the Lucknow Super Giants. Mangalam, just a clarification. RCB, the holding is entirely, it's all held, 100% holding via the listed entity, United Spirits?
So RCB and SRH are the two teams which are 100% held by the listed entity. 51% of LSG is held by RPSG Ventures. The other 49% is held by, privately held entities of the Sanjeev Goenka Group. And I must, once again clarify that CSK is not owned by India Cements. It was demerged way back in 2017 or 2018, if I remember correctly. And none of the Reliance listed entities own Mumbai Indians as well. So from a listed company standpoint, there is just RCB, SRH and Lucknow Super Giants.
Okay, all right. Very interesting data. And thanks for that quick analysis as well. So the IPL is big business. We know that. And those numbers are speaking. Those valuation numbers are moving higher. Let's see where this goes. If nothing else, I think for the investors, it's a great feel-good factor. Now, whether there is any offloading or not, whether any money comes into the listed entity, that's a separate matter.
I'll tell you one quick story with regard to these IPL valuations. India Cements, there were a lot of shareholders on the call that had said, we want CSK out of the India Cements business. We don't want it to be part of the listed entity. So, Mr. Srinivasan, there was a lot of, there were various allegations with regard to that betting problem and all. So, what they did was that, okay, we will demerge it. I recall on that day, the share price adjusted by around 2 rupees, 2 rupees approximately. In the unlisted market, the share price currently is much higher than it's around 175, 185 rupees, very, very roughly. So, actually, the CSK brand that were, according to what shareholders wanted, it was done by the management, they removed it from the listed entity. It became valued even more than the India Cements business ultimately because and I recall at that point of time the ask was move this out of the listed entity, and as if you look back, actually you would have wanted to be there because they had a lot of debt on books, but it's not part of the listed entity at all from 2015 onwards. That was when the record date did come out.
Okay, all right. So that's the business of IPL, listed and unlisted as you know it. Always an interesting spot. Well, with that, let's move back to the market conversation. We have Jay Bala joining in. Jay Bala, of course, is from Cash the Chaos. Jay, great to have you on. Thanks for being with us. Market seems to be getting into no man's land. It's very, very listless, 17, 18, day trading range. What's the sense? And yesterday there was, it failed to have any convincing breakout of the trading range on the upside. Pretty much similar today as well. What do you make of this consolidation?
I think there is a mild breakout that's already happened, Surabhi. The fact that Nifty is trading about 24,116, or it traded about, that's a positive for me. Although it didn't close about, I think it will probably do it. I think I have a slightly different opinion, but I want to caveat it a bit. The next 1,000 points on the Nifty is possibly coming to the upside, and it could be quite fast. And because of my interpretation of the wave structure of the move from the April low, I think there is a reasonable possibility that Nifty could accelerate, and we could have all-time highs as quick as July. But the Nifty needs to hold about 24,300. But if 24,300 were to break, this bet is off. Although the longer-term picture, from a 6 months to 12 months time frame, I'm still anticipating 29,000 plus on the Nifty.
Okay, all right. Hi, Jay. Good afternoon, and good to see you. And you're saying the bias is on the upside, and we could have a quick fire 1,000 points. We'll wait by for that. But the real action has been in the broader markets, and you've been giving us some exciting picks. If I remember correctly, a couple of weeks ago, you spoke about Schneider Electric. The stock did quite well. Last week, you spoke about Puravankara and Lloyd Metal. I take note of all these things, Jay. And they've done well. So if you want to give us a revised call on any of these stocks which you've already recommended in the past, and also for today's show, what are you recommending?
Yeah, I've been bullish on real estate space since the 20th of May, and I said the knock-on effect is likely to come in other sectors. So when it comes to Schneider Electric, I'm bullish on it, and I'm expecting all-time highs to come through, take out the 2024 high, which happens to be the all-time high. When it comes to Puravankara, it's rallied about 32% from the time we spoke last week. And so we can, bring up the stocks to just 10% below the entry point of last week. And for this week, I have, a spillover that has happened possibly because of the real estate sector. I pointed out last week too. It's the cement space. I have two calls from there. One is Ultratech. Like I pointed out, it exactly bottomed around 11,000 mark. So 10,900 is a stop. I'm anticipating fresh 52-week highs to come through for Ultratech. And Grasim also is the top gainer on the Nifty today. As long as it can hold about 2,500, I think fresh 52-week highs are likely to come through. This is again sector rotation. I'm also anticipating something to happen in the Nifty Pharma space. Watch out for it. If Nifty Pharma starts trading about 22,100, I think Lupin will be the leader.
Got that. Jay, we'll continue our conversation in just a bit. As we slip into a very short break, let's get our viewers some important conversations. India is the place to be for the next few years. That's the word coming in from Klaus Rosenfeld, Global CEO of Schaeffler AG. He spoke to Prashant about how Schaeffler is navigating the unpredictable global environment and why India is central to its future. Listen in.
The environment is very dynamic. It is an environment that is unpredictable. It's an environment that is certainly challenging to navigate. Certainly this is something where you need to be agile. And agile starts with listening, analyzing, and interpreting very carefully what's happening. That requires an open mindset. It also requires experience. I've been leading this group now since 2014 as a CEO, and I have to say I've never seen something like this that is so fast changing, and I also have to say so much dependent in certain areas on decisions of single individuals like President Trump. However, it's not just agility that counts here. I think what really counts is resilience. And resilience comes certainly from the business model.
Whether there is a push from certain partners, and that seems to be the general feedback that we get, that too much of manufacturing is out of China. So you need to sort of be based out of everywhere, other places as well. So China +1 in that sense.
Oh yeah. Sorry, then I misunderstood the question. For sure. I mean, the catchword here is diversification. I mean, we cannot afford to, put all the eggs in one basket. And that's why India is so important. India, from my point of view, is the place to be for the next years. India is one of the economies that is growing faster than many other countries. India has some natural advantages that other countries don't have. You have this vast pool of talent. You have big infrastructure programs. You have political stability. You have a government that leads now through several years very continuously into the right direction. And that is something positive. And that's why we see India as one of the key growth regions for us, also balancing risk and rewards in this global world. And that's why I'm here today in India, to look after the opportunities we have, see what our people are doing, also in terms of integration. So India is high on my list as a part of the markets where we want to also diversify.
Constantly on purpose, constantly on
Welcome back. Look at the Nifty. Neither 1 point up nor 1 point down. It's that kind of a quiet day. Let's quickly try and squeeze in some last thoughts from Jay as well. Jay, financials. After the RBI policy, everyone's looking at this part of the market. What would be your top trades on the long side?
Yeah, I don't have a long candidate yet, but this is the confusing part of the market. This is struggling right on the 57,000 mark. Possibly it's pulling back to 55,600 and then heading to the medium-term objective that I've been having for about 58,000 to 59,000. HDFC Bank and ICICI Bank, which I had been bullish, have already rallied. I think the heavy lifting needs to come from State Bank of India. That's the problem pocket for the Nifty banking index. The structure isn't as good, but if it were to take out 850, possibly the negatives will subside, and we need to relook at the stock.
Jay, anything in the IT pack? I think that's the only space where you are seeing some green, at a sector level.
Yeah, the relief rally that I'm counting this as a relief rally. I'm still anticipating one more higher high to come through, possibly closer to 40,000. The strongest stock within the space is possibly Tech Mahindra. Tech Mahindra looks quite promising in the short term. I would anticipate for the high highs to come through at somewhere close to about 1,800 to 1,900 mark. Having said that, when Infosys, from a very short-term perspective, possibly heading to somewhere close to 1,650 to 1,700. So treat this as a short-term move. But if you're bullish on anything for the medium term, I think Tech Mahindra, Coforge, and Persistent, they are the names to beat.
Okay. Jay, I think earlier you were talking about crude taking a bit of a leg down and then going rocket up. Now, in the last few days, actually, it's suddenly coming back into play, and the crude bulls will be feeling quite happy at around, I think it's closer to $68 per barrel. Where is it headed?
It's clocked, confirmed a double bottom, Nigel. It's heading somewhere close to $78. So I won't treat this as a cause for worry. It's probably consumption from Asian side picking up, and that's probably trying to lift the markets up. As you've been pointing out at the beginning of the show, consumption is pointing to pick up. So that's probably providing the tailwind for crude. The $78 I have is on the NYMEX, not on the Brent variety. Brent variety is trading about $3, roughly about $3 higher, so possibly 80 plus for Brent.
Okay. And what about silver? Will it shine brighter than gold?
Yeah, we pointed out last week, and it's been doing exactly that for the last 5 sessions. I think it's nearing an endpoint. The resistance for silver comes about 37.5 to 38 on COMEX. So one more sequence of higher high pending with a very short term. Post that, I think both gold and silver will start to correct. But as very short term, one more sequence of high pending closer to 37.5 for COMEX silver.
Jay, hold that thought. Just counting down to the close, and it's been a very lackluster kind of a trading session. The Nifty unchanged, closing just shy of the 25,100 mark. Flat on the Nifty, Sensex down just about 87, 85 odd points. But bear in mind, for the last 2 days, the Indian markets rallied on the back of the RBI's liquidity injection and the rate cuts. So today, a bit of pause, a bit of a consolidation after the up move. Sectorally, I think the Nifty IT index did well, and you had green on the defense and the pharma and the metal index. So the Nifty IT index 1.7% up, defense did well. Yesterday came in for profit booking, but it's rebounded today 1% up. Pharma moved up, and the metal index, at least it's cooled off from the day's high, but still managed a positive green tick by the close of trade. On the way down, you had softness in realty. PSU Bank saw a bit of profit booking. In fact, so did the entire banking complex, with the Nifty banking index down nearly about 0.5%. So profit booking visible there.
Well, in the broader markets, though, plenty of stocks are moving around. You had Ratan India, a stock that we don't talk about very often. Ratan India, Ratan Enterprises, both of them were up 20%. Not sure what's going on there. Reliance Power is up close to around 11%. Big move out there. Ujjivan Small Finance Bank up 6.5%. Lloyd Engineering Works, the other play on Lloyd Metal, that's already had a great run. That one as well was up and about. Remember, they recently did a rights issue, and post that the stock has been moving from strength to strength. Jindal Saw, they did a capex, the street likes it, it's up and about. MTNL, one of those bombed out stocks, some positive news flow coming in there. That stock as well was up. And Z Enterprises actually very, very silently, it's moved briskly from around 95 rupees from when the promoter entity started creeping in to around 131 rupees or thereabouts. But there were plenty of winners actually from the broader markets, though the headline index ended more or less flattish. Tell you what, we'll wrap up on this edition of Closing Bell. Stay with us. Markets Forward comes up next.